You know what's odd about how we talk about money? We obsess over boomers and their real estate, analyze millennials and student loans, and write endless takes about Gen Z and side hustles. But there's a generation sitting quietly in the middle that built more financial stability than anyone expected. And almost nobody talks about them. Generation X, born between 1965 and 1980, is now in their mid 40s to late 50s. According to Federal Reserve data, the median Gen X household net worth is around $243,000, nearly 4 times higher than that of millennials, and far ahead of Gen Z. And they did it without podcasts, without YouTube, without apps constantly telling them what to do. What makes this so interesting is how they got there. Gen X followed the rules early on: work hard, save consistently, stay loyal. Then 2008 happened. Retirement accounts were cut in half, home values collapsed, companies laid off people who had done everything right. The formula they trusted stopped working. Instead of giving up, they adapted. They became more skeptical, more self-reliant, and more disciplined. Only 38% of Gen X investors use a financial advisor, far fewer than other generations. They chose to understand the basics themselves and stick with simple, repeatable decisions. I'm Alex. Today, we'll break this down in layers, from how Gen X learned money without noise, to how they structured income, debt, and spending to survive multiple crashes without breaking. If you understand these patterns, you stop chasing financial confidence and start building it. You stress less during downturns, make clearer decisions under pressure, and design a system that keeps working even when the economy doesn't. And it all starts with the first defining choice Gen X made: learning how money works for themselves, instead of outsourcing belief to anyone else. Self-education over financial advisors. Gen X didn't reject advice because they were reckless. They rejected it because they wanted control. Only about 38% of Gen X investors use a financial advisor, far lower than both older and younger generations. Instead, they chose to understand the basics themselves: how fees work, how taxes quietly erode returns, and why small decisions repeated for years matter more than clever moves. Here's the part most people miss. Managing your own money doesn't mean trading every day or chasing hot stocks. For Gen X, it meant owning simple portfolios, often index-based, and refusing to pay 1% every year for something they could learn in a weekend and refine over a lifetime. Over 15 years, their self-managed portfolios averaged returns in line with professionally managed accounts, but with far lower fees. That gap compounds quietly. Think about a typical example: a 45-year-old contributing steadily to a retirement plan, rebalancing once or twice a year, ignoring noise, no constant calls, no product pitching, just discipline. That alone can mean hundreds of thousands more by retirement. The micro shift was psychological. When you understand why you own something, you don't panic when markets drop. You don't outsource conviction. You stay invested while others freeze or sell. Gen X didn't become experts overnight. They became comfortable enough to trust their own judgment, and that comfort turned into one of their biggest financial edges. Learning money before the internet era. Gen X learned money in a slower, quieter environment, and that turned out to be an advantage. In the late 1990s, if you wanted to understand investing, you couldn't scroll or binge watch. You had to sit with the material: books from the library, monthly issues of Money or Kiplinger, long-form articles that explained why, not just what to buy. That process forced patience. You didn't skim headlines, you followed arguments. You learned what price to earnings actually meant, how dollar cost averaging worked in practice, and why compounding only shows its power after years, not months. Concepts that feel like slogans today were once studied carefully, sometimes with a calculator on the kitchen table. Here's the contrast that matters. Early online forums were small and slow. People shared ideas, not products, no affiliate links, no urgency. If someone said a stock was interesting, you had time to think before acting. That delay alone filtered out bad decisions. Many Gen X investors read Warren Buffett's annual letters when they were just dense documents, not social media quotes. They absorbed the logic behind patience and valuation long before it was popular. The quiet benefit? When markets later got louder, faster, and more emotional, Gen X already had a framework. They weren't overwhelmed by information. They were anchored by understanding. And that made all the difference. Formative market crashes built real confidence. Gen X didn't learn risk in theory. They learned it the expensive way. The dot-com crash wiped out nearly half of the tech-heavy market between 2000 and 2002, and many Gen X investors were holding stocks they barely understood. The lesson came fast. Hype fades, earnings matter, and stories don't protect capital. What's important is what happened next. They didn't quit. They studied why certain companies survived while others vanished. They learned to separate real businesses from speculation. That experience rewired how they respond to noise. When everyone starts talking about easy money, Gen X tends to slow down. Then came 2008. Housing collapsed. Markets fell over 50%. Retirement balances shrank on paper. Yet Gen X showed some of the lowest panic selling rates of any generation. And not because they were fearless, but because they knew what they owned. They understood downturns were part of the system, not a signal that the system was broken. Fast forward to March 2020. Markets dropped over 30% in weeks. Many investors froze. Gen X, shaped by earlier scars, kept contributing. They'd already lived through worse headlines. Here's the quiet edge. Confidence built from surviving losses is different from confidence built from gains. One disappears when markets fall. The other shows up exactly when it's needed. And that difference compounds just as powerfully as money does. Portfolio thinking applied beyond investing. Gen X didn't stop diversification at stocks and bonds. They treated their entire lives like portfolios. Careers, skills, income sources, everything was built with redundancy in mind. Not to get rich fast, but to avoid being fragile when something broke. Look at a typical setup. One stable job with benefits covers essentials and retirement contributions. On the side, there's consulting, contract work, or a small service business bringing in extra cash, maybe a rental property that doesn't change lifestyles, but quietly adds monthly income. None of these are meant to replace the main job. Together, they reduce risk. This thinking showed up clearly during economic shocks. When layoffs hit, Gen X households were less likely to lose all income at once. If one stream slowed, another carried the load. That's not hustle culture. That's insurance built into daily life. Here's the part that often gets overlooked. Portfolio thinking also applies to skills. Gen X kept learning tools that transferred across industries: management, sales, technical knowledge. So job changes didn't reset them to zero. That flexibility mattered more than chasing the highest salary in any single year. The quiet insight is simple. Wealth grows faster when survival isn't constantly in question. By designing their lives to absorb hits, Gen X gave themselves the one advantage most people underestimate: the ability to stay in the game when others are forced out. Strategic income diversification. For Gen X, having multiple income streams was never about quitting a job or chasing passion projects. It was about strategic redundancy. Data shows roughly a third of Gen X households earn money from more than one source, higher than both older and younger generations. But the mindset behind it matters more than the number. Picture a household where one income pays the bills and funds retirement automatically. A second income, freelance work, consulting, or a small online business, covers irregular expenses and builds cash reserves. Add a modest rental property generating steady monthly cash flow. None of these alone feels life-changing. Together, they change everything. Here's the contrast. When one stream dips, the household doesn't panic. They adjust, bills still get paid, investments stay intact. During recessions, this structure shortened unemployment gaps and reduced forced selling. That's not luck. That's design. Gen X also avoided turning side income into lifestyle upgrades. Extra money didn't automatically mean a bigger house or newer car. It meant flexibility. Emergency funds grew faster. Opportunities became easier to act on. The subtle advantage is timing. When markets drop or assets go on sale, diversified income creates breathing room. You don't need perfect courage. You just need enough stability to say yes when others can't. And that's how quiet opportunities turn into lasting wealth. Using downturns as opportunity. Gen X didn't rush into opportunities because they were bold. They moved because they were prepared. When the housing market collapsed and prices dropped roughly 40% from prior highs, many households were frozen by fear. Gen X, with cash flow from multiple income sources, was in a different position. Between 2010 and 2015, while headlines were still warning about risk, Gen X quietly bought. Starter homes turned into rental properties. Retirement contributions increased when stock prices were still depressed. Mortgages were refinanced at historically low rates. None of this required genius timing. It required the ability to act while others couldn't. Here's a simple example. Buying a discounted property with stable income backing the payment meant rent covered most of the cost. Appreciation came later, almost as a bonus. In the market, consistent contributions during down years locked in lower prices that paid off over the next decade. The contrast is sharp. Many people recognize opportunity only when it feels safe, and by then, it's expensive. Gen X learned that opportunity usually looks uncomfortable at first. The hidden advantage wasn't bravery, it was margin. Enough savings, enough income stability, enough confidence to move when conditions were favorable, not popular. That margin turned downturns from threats into accelerators. And once you experience that shift, you never see recessions the same way again. Selective and strategic use of debt. Gen X was never anti-debt. They were anti-bad debt. The rule was simple and consistently applied. Borrow only when the debt either appreciates or produces income. That's why mortgage balances stayed high while credit card balances stayed low. They'd sign a 30-year mortgage without hesitation, but walk away from financing a couch or a car upgrade. The logic wasn't emotional. A home or rental property has long-term value and tax advantages. A finance purchase that loses value the moment it's used does the opposite. It drains future options. This mindset became especially clear when interest rates dropped. Gen X refinanced aggressively, locking in low fixed payments and redirecting the monthly savings into investments. At the same time, they attacked consumer debt with urgency. Credit cards, personal loans, auto loans, anything with double-digit interest got eliminated fast. Here's the contrast that matters. Many people think debt is either dangerous or harmless. Gen X treated it like a tool that can either build leverage or quietly sabotage progress. They didn't mix the two. The subtle advantage shows up over time. Lower consumer debt means fewer fixed obligations. Fewer obligations mean flexibility. And flexibility is what allows you to invest, hold, and move when conditions change, while others are stuck servicing yesterday's decisions. Timing debt with economic cycles. Gen X didn't use debt whenever it was available. They used it when conditions made the math obvious. When asset prices were high and optimism was everywhere, they stayed cautious. When prices were down and fear dominated, they leaned in. Between 2010 and 2012, real estate values in many areas were still deeply discounted, and long-term mortgage rates hovered near historic lows. Gen X saw the rare overlap: cheap assets and cheap money. That's when borrowing makes sense. They bought properties below prior peak prices and locked in fixed payments that barely moved for decades. The contrast shows up in behavior before the crash. In the mid-2000s, while others treated home equity like free cash, funding cars, vacations, and lifestyle upgrades, Gen X largely avoided cash-out refinancing. They understood that pulling equity during inflated markets increased risk without increasing resilience. Here's the quiet insight. Debt is most dangerous when it feels normal and safe. It's most powerful when it feels uncomfortable and unpopular. Gen X learned to recognize that inversion. This timing discipline created asymmetric outcomes. When markets recovered, appreciation worked in their favor. When conditions changed, fixed low payments stayed manageable. They didn't need perfect forecasts. They just needed patience and the willingness to wait until borrowing actually improved their position, not their lifestyle. Stealth wealth and anti-consumption behavior. Gen X built wealth without advertising it. They had money, but they didn't perform it. No posts about raises, no photos of new cars, no quiet pressure to keep up. That invisibility created freedom most people underestimate. Research shows Gen X is the least likely generation to share financial wins online. The result is practical, not philosophical. When no one knows you have money, no one expects you to spend it. There's no lifestyle competition, no subtle guilt when you don't upgrade. You see it in everyday choices. A 12-year-old sedan with 180,000 miles still in the driveway, even though the investment account is well into six figures. Not because they can't afford a new one, but because they've done the math. The $45,000 upgrade invested at reasonable returns can quietly turn into nearly six figures over time. The car already works. This isn't extreme frugality. It's selective indifference. Money is saved for things that compound, not things that depreciate. Homes aren't constantly upsized. Vacations are enjoyed, not documented. Spending aligns with comfort, not image. The deeper advantage shows up socially. Fewer requests, fewer expectations, fewer explanations. Wealth grows faster when it's not dragged into comparison. Gen X learned that the quiet path doesn't just protect money, it protects decision-making, which is far more valuable in the long run. Consistency and the power of time. Gen X's biggest advantage wasn't timing or talent, it was staying invested when it felt pointless. For more than 2 decades, they kept contributing through crashes, recessions, and headlines that promised the system was broken. That consistency did the work most people expect strategy to do. Consider a simple example: investing $500 a month starting in the late 1990s into a broad market fund meant contributing roughly $156,000 over time. By early 2024, that account could be worth well over $500,000. No stock picking, no perfect entries, just repetition. What makes this hard isn't the math, it's the patience. Gen X lived through the dot-com collapse, the 2008 crisis, and the 2020 market drop, where prices fell more than 30% in weeks. Each time, there were confident voices saying recovery might not come. Gen X kept showing up anyway. Data on investor behavior shows they were more likely to maintain uninterrupted contributions over 20-plus years. They didn't stop during downturns or pause when life got expensive. They understood something most people underestimate: money invested early works longer and harder than money invested later. The trade-offs were real: fewer upgrades, slower lifestyle changes, but time rewarded those decisions quietly. Wealth didn't arrive suddenly, it accumulated. And once compounding reaches scale, it becomes self-reinforcing, almost boring to watch and impossible to rush. Key takeaways: what Gen X got right wasn't a secret strategy, it was alignment. Their choices matched how money actually behaves over long periods, not how it feels in the moment. They learned enough to trust themselves, diversified their lives to reduce fragility, and treated visibility as a liability rather than a reward. Debt wasn't avoided or embraced blindly. It was timed and filtered. Spending wasn't eliminated. It was deprioritized when it didn't compound. The common thread is restraint, paired with patience. Not waiting in fear, but waiting with structure. They built margins that allowed them to act when others hesitated and to stay still when others panicked. Over time, those small, unremarkable decisions stacked into outcomes that now look impressive in hindsight. This isn't about copying a generation, and it's about recognizing that financial progress often comes from removing pressure, not adding intensity. When your system is built to survive stress, time becomes an ally. And that's where real security starts to form.